Before you buy your first stock, someone needs to sit you down and explain these 5 simple things. And if you're new here, I'm Nate. I've been around this market for years. I dig into the moves the people at the top are making, so you don't have to read the fine print yourself. The reason most beginners lose money isn't bad luck. It's that nobody ever handed them a checklist. So here it is, 5 things, every stock, every time. Number 1, know what the company actually does. This sounds obvious, but it's not. Would you lend your friend, say, $1,000 without knowing what they do for work? Probably not. But people buy stocks in companies that they can't describe in one sentence every single day. Before you buy anything, just ask yourself, what does this company sell? Who buys it? And how does it make money? If you can't answer that, you're not investing. You're probably guessing. And the industry with it matters too. Stocks in the same industry move together. Say if, oil prices drop, pretty much every energy company in that sector is going to take a hit. If interest rates rise, bank stocks feel it. Your stock doesn't exist in this little vacuum or anything. You know the world it lives in. Number 2, it's market cap. Sounds a little technical, but it isn't. Think of it like this. There's a difference between, say, putting money into McDonald's and putting money into a new burger place that just opened down the street from you. Both might make you money, but one is a global operation worth hundreds of billions with a 50-year track record. The other might be the best burger you've ever had, or it might be closed in 6 months. Market cap is just the total value of the company. Big company is more stable and has slower growth. Small company, more volatile, more upside, but also more risk. Knowing which one you're buying tells you what kind of ride you're in for. Number 3, the PE ratio. This is the one nobody really explains properly, but it just stands for price to earnings, and here's all that it means. Take a lemonade stand that makes $1 a year in profit. If someone asks you to pay something like $20 for it, that's a PE ratio of 20. Meaning at the current profit level, it'll take 20 years to earn your money back. It's kind of normal for a stable business in the public space, but if someone asks you to say pay $100 for that same $1 stand, that's a PE ratio of 100. Now that lemonade stand needs to grow a lot fast to justify what you just paid. High PE isn't automatically bad, it just means the market is betting on future growth. The danger is when the growth doesn't show up and you paid 100 times earnings for a company that turns out to be worth 20. Number 4, revenue trend. Would you invest in a store that makes less money every year? Revenue trend just asks one question. Is the business growing or shrinking? Look at the last 4 quarters. Is the number going up consistently? Because Wall Street is always asking that exact question. And when the answer changes from yes to maybe, the stock usually drops before most people even notice. And number 5, who else owns it? Would you eat at a restaurant where the chef refuses to eat their own food? Insider ownership really tells you if the people actually running the company believe in it enough to own shares themselves. When a CEO is buying stock with their own money, that's a good signal. When they're quietly selling, oh, that's a signal too. And check the institutional ownership. That's the percentage held by big professional funds. If the people who do this full time have a large position in the stock, it's kind of worth noting.